Welcome to The Explainer. Today, we're totally stripping away the financial hype, the confusing jargon, and those endless money myths to bring you a premium, documentary-style breakdown of exactly how your credit profile actually works. Look, if you've ever felt like the financial system is this locked door and you're just missing the key, you are absolutely in the right place. We are going to visually map out exactly what lenders are looking at behind the scenes when they evaluate you and show you how to take control of your own financial narrative. Picture this. Why can two people, sitting at the exact same desks, pulling in the exact same salaries, walk into a bank and get completely different borrowing offers? One walks out approved for a super low interest mortgage, and the other gets flat out denied. It's a mystery that frustrates so many of us, but the answer is right in front of us. You see, income is really just how much money you make. It tells a lender absolutely nothing about how you actually manage it. To figure that out, they look at your credit profile. But as you'll see, a credit score is only one piece of a much, much larger puzzle. So let's establish a really clear baseline here. A credit score isn't some permanent grade etched onto your permanent record. It's actually a highly fluid, algorithmic estimate of risk. It's this constantly shifting calculation used as just one part of a lending decision. And here's the crucial thing to understand early on. There is no single universal magic score used by every single lender. Different institutions use completely different scoring models to evaluate the exact same credit report. Okay, let's dive right into this. Here is our roadmap to demystify the system block by block. 1. Payment history and utilization. 2. History, applications, and debt. 3. Finding credit report errors. 4. US versus UK differences. And 5 essential credit takeaways. All right, kicking things off with Section 1, Payment History and Utilization. I know it seems almost incredibly simple, but this little 3-step loop, it's literally how you train lender algorithms. Step 1, your payment due date arrives. Step 2, you pay the obligation on time. And Step 3, a positive payment history is established. By repeating this exact cycle month in and month out, you are essentially manufacturing predictability. You're proving to any future risk model out there that when you borrow money, you give it back precisely when you said you would. But, life happens. What actually goes down when that cycle breaks? Well, a missed payment basically signals that your predictable loop is broken, immediately flagging you as a higher risk. But here is a truly fascinating detail to keep in mind. These algorithms are incredibly sensitive to time. They weigh your recent behavior way more heavily than your past mistakes. So a missed payment from just last month, that'll severely impact a risk model today. But a single missed payment from, say, 4 years ago, that carries significantly less weight as time marches on. Now, what's really interesting about this slide is a massive factor called credit utilization. This is just the relationship between the credit you have available and the credit you're actually using. Let's say you have a $1,000 limit. When lenders see low utilization, like 20% or $200, it signals restraint. It proves you have access to debt, but you aren't reliant on it to survive. You aren't desperate. Lenders absolutely love to see this because it shows you can be trusted with open lines of credit without immediately just spending them all the way down to zero. On the flip side, pushing that utilization up to, say, 95%, that triggers some serious alarm bells. Even if you're making your minimum payments perfectly on time, a nearly maxed out limit suggests cash flow distress to a risk model. It implies you might be relying way too heavily on borrowed money just to get by month to month. Now, while no exact percentage guarantees a specific score, the rule of thumb is simple. The lower your utilization, generally, the better it is for your overall credit profile. Moving right along to Section 2, History, Applications, and Debt. Let's talk about credit age. This is a massive concept because in the financial world, time is literally one of your greatest assets. Think about it. A 1-month-old account has a very short history. It leaves lenders totally guessing about your 2 habits. At 1 year, you're establishing a consistent rhythm. But at 5 years, that older, well-managed account removes the guesswork entirely. Lenders heavily value the length and quality of your credit history because it proves you have the endurance to manage your financial obligations over the long haul. Next up, we really need to talk about who is looking at your credit and why. A soft check is just a routine review. It has absolutely zero impact on your score. A hard check, however, happens when you officially apply for new credit, and generating too many of these can definitely look like financial distress. But here is a crucial nuance you should know about: the rate shopping window. If you're shopping around for a mortgage or an auto loan, algorithms typically group multiple hard checks within a short time frame, usually 14 to 45 days, as just a single inquiry. The system is smart enough to know you're just looking for the best interest rate, not trying to buy 5 houses at once. Lenders are also analyzing your credit mix. They're looking at the different buckets of existing debt you hold, things like credit cards, personal loans, auto loans, and mortgages. Basically, lenders combine all of these into a simple financial dashboard to assess your overall debt load and capacity. If you already have a massive mortgage, a huge auto loan, and a ton of revolving credit card debt, a new lender might just look at that and decide you simply don't have the bandwidth to take on more debt safely, regardless of how high your income actually is. All right, shifting gears to Section 3, finding credit report errors. Look, mistakes happen all the time. In fact, studies show that up to 1 in 5 people have a potential error on their credit report right now. That could be something like an incorrect address, or way worse, a defaulted account that you never even opened. So here is a super simple, empowering 3-step action plan to protect yourself. Step 1, regularly check your credit reports. Step 2, identify any of those errors. And Step 3, dispute the error and contact the provider directly. It is your absolute right to have an accurate profile, so make sure someone else's mistake doesn't end up costing you a prime interest rate down the road. Next up, Section 4, US versus UK differences.
And this brilliantly illustrates how things get a bit complicated depending on geography. The systems are actually completely distinct depending on which side of the ocean you stand. In the USA, you're dealing with credit reporting companies that use several different proprietary scoring models. Over in the UK, the terminology shifts. They call them credit reference agencies. But more importantly, in the UK, the emphasis is heavily placed on the fact that lenders use their own highly specific criteria to evaluate you, rather than just relying on some standardized, outsourced score.
But honestly, regardless of where you live, this one crucial fact remains true. A high score does not automatically guarantee approval. I'm going to say that again because it's quite literally one of the biggest myths in finance. A high score is not a golden ticket. Lenders can and actively do use their own internal criteria and additional information like your overall income and your employment stability to make their final decision. So chasing a specific 3-digit number is just far less important than focusing on your holistic financial health. Which brings us to Section 5. 5 essential credit takeaways. All right, let's distill all this complexity down into your personal finance playbook. Ready? 1. Pay your obligations on time every single time. 2. Avoid unnecessary borrowing. Look, just because you can get a loan doesn't mean you actually should. 3. Keep track of your credit utilization. You really want to keep those balances low relative to your limits. 4. Avoid making unnecessary credit applications so you can protect your profile from an avalanche of hard checks. And 5. Check your credit reports for errors regularly. So circling back to that mystery we started with, your credit score isn't your entire financial life, but understanding your credit profile can absolutely help you make better borrowing decisions. And that right there is exactly why 2 people with the exact same income can get completely different offers. One of them actually understood how to manage their credit profile, and the other one just didn't. Because at the end of the day, knowledge is the absolute best investment you can possibly make. So ask yourself, is your financial behavior training the algorithm to work for you, or is it working against you? If you want more of these simple, no-nonsense explanations of money, credit, and the economy that actually give you a real edge, make sure to hit that subscribe button for our next finance breakdown. Understand your money, make better decisions, and I will see you in the next explainer.